Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks. And in today's episode, we're going to take a look at how you can diversify your trades and investments if you're an option trader. Now, if you're trading stocks or investing in the stock market, it's a little bit easier to diversify because you're kind of, hey, let me get a few telecom companies, a few oil companies, and now you're diversified. Or in simple words, you could just go ahead and buy an ETF or a fund, and now you're pretty much diversified. But when it comes to trading options, it's a little bit different. So that's what we're going to go over in this video. So stay tuned, and if you're not on the newsletter already, be sure to get on it because we have a new book coming out soon. Okay, so let's take a look at figuring out how you can diversify if you're an option trader. Now, let's look at a normal investor or a normal stock trader, the way that they diversify. Typically, the majority of people, let's say we have this basket of stocks or basket of holdings, you'll typically diversify things in different areas. It might be 4 stocks, it might be 5 stocks. Overall, let's just say you have something like an oil company, you could have some in tech, you might have some in retail, you might have some in food related, and maybe utilities. Okay, so that's kind of an overall picture of how people diversify in general with a stock holding. Now, overall, if you have, let's just say, an overall portfolio, that part, you might only have some overall in stocks. Okay, you might have some in real estate, you might have some in other investments. This could be gold coins, could be other things. So in either case, what you're really looking at normally is you have distribution of funds, and that's the way normal people do it. But when it comes to options, it's a little bit more difficult. So when we look at option diversification, you have a couple of ways to diversify. Now, number one, you could go ahead and diversify based on the car or vehicle that you're trading. So the vehicle that you're looking at. So, for example, you might have Netflix, you might have Apple, ExxonMobil, let's say AT&T. It could be in eBay. It could be, let's say, Under Armour or something else. So all of a sudden, you're looking at the difference of your vehicle. That's your car. Okay. The other way you could do it is looking at the time frame that you're trading on. Now, with time, you have some options that you're doing 30-day trades on. Other things you could do 60 to 90-day trades, or other things you might even do 350 plus days. So this might be more longer term investing. So one way to really split your risk and diversify is, on certain trades right here, this is more money every month trades. Other ones are more long-term investor type trades, just like you would holding it here. So by diversifying based on your time of the holdings and when you're putting on the trade as well, that can really split things up and reduce your risk. And the third way to do that is based on the volatilities, okay? And this is based on really the strategy that you use. So for example, if you're doing some trades that are, let's say, iron condors and some trades that are butterflies, these are all negative vega trades, okay? Now, to combat that, the volatility risk, what are some positive vega trades? Okay, some positive vega trades would be something like a calendar or a diagonal or a double diagonal. But now this would combat the iron condors or the butterflies. So really you have kind of 3 ways to diversify when it comes to options and split the risk. So number one is change the vehicle that you're trading, or the car in this case. And that would be, your stock, the overall thing that you're trading. So that would diversify you a little bit. The other thing is the time frame. So if you're looking at normally doing 30 to 40, 50-day trades, money every month kind of trades, what if you can now go ahead and do things that are maybe 180 days and some that are 350-day trades. Now that gives you a little bit more diversification. So combining these two already will give you some diversification. And the third is, well, if you can create some that are negative Vega strategies and some with positive Vega strategies, now all of a sudden you have a pretty good mix between these three different mediums. So it gives you a good variation to a portfolio when you're trading options. So let's say you went ahead and started creating something on a trade. Well, let's say with Netflix, you went ahead and you did an Iron Condor and you did a 40-day trade, okay? Then on, let's say, ExxonMobil, you did a calendar, but you did a 360-day trade. So you can see how now this really starts to diversify you quite a bit already. And then let's say you do SPY, and maybe you do a butterfly and something around 180 days. So you start to see, okay, well, if I can mix and match, this is short Vega, this is short Vega, and some shorter term and medium term and longer term trades, and something that's already ETF and 2 stocks, you can see how now that diversification plays a nice role within your option trades. And it works a little bit different than a portfolio because you, with a regular stock portfolio, because you have more elements in there. You have a time element with options because they're decaying. And you have a volatility element as well because you have positive Vega and negative Vega, which, you know, can hurt you on the risk side if one goes against you. So anyways, this is what I would look at if you're trying to evaluate your option portfolio, is take a look at, you know, the vehicles you're trading. Look at the diversification of that. 3 to 5 vehicles is more than fine. Look at the time horizon. If you're all doing, you know, 30-day, 40-day trades, well, maybe you want to step it up and do some longer term trades. I mean, you could even do, instead of a 40-day, you could do like a 10-day trade. That's fine too. 5-day trade. That's fine too. All I'm saying is a mix. Short-term duration, longer-term duration. And then, of course, look at the volatility. So some could be shorter-term vol strategies, and others could be longer-term volatility strategies, like a double diagonal or a calendar spread. Okay, so I hope you found this video helpful. If you're trading options, be sure to take a look at some of our free training on the Traders Fly website, and take a look at some of the detailed courses that we have available on options if you want to learn a little bit more. Some courses, 18+ hours of detailed training. And of course, get on the newsletter list so that way you can get notified as we release new goodies. And in this case, we have a new book coming out called Mindsets of a Master Trader. So take a look at that, or also click the link in the description below, and you'll be taken to a sign up page where you can get notified when we release it. Thanks again, and I'll see you next time.